Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so yesterday we did episode 1000,
Woohoo!
and I think we're just gonna we'll keep numbering them, but I actually got the thing from YouTube
Okay.
today saying you did your 1000th upload.
Very awesome. So we know if YouTube said it, it must be true.
Yeah, so I went and counted, and I didn't know what it counted, but it counted them all properly. So anyway, all right.
Okay, so if you like our videos, please remember to subscribe and hit the notification bell so you get notified when the next video comes around. Let's go.
Okay, I saw this article. The headline caught my eye. Like, isn't that what headlines are supposed to do?
Absolutely.
So it inferred something, and I went to read the article to see. It said, this is in Forbes, I think. It said, Wall Street is running away from the housing market. But why? And I thought, that's interesting. I mean, why running away? You would assume they're selling all their houses, right?
Well, yes. But there's more to the story, right?
More to the story. All right. And here's the first quote from the article. In fact, according to an analysis conducted by John Burns Research and Consulting, institutional investors, those owning over 1,000 homes. So first of all, they're only talking about the big institutional buyers. Mm-hmm. Bought 90% fewer homes in January and February than they did the first 2 months of 2022.
Okay. Well, that makes sense for a lot of reasons. First of all, let's start with lack of inventory.
Okay.
Then we can talk about higher interest rates, even for them. So
Yep.
that's another reason.
Interest rates are substantially more.
Right. And then
like 6% higher. It's
right.
much higher for them.
And then there's uncertainty in the economy, so it's much more difficult for them to sort out what markets are going to be up and coming in the next wave. Because remember, that's part of their matrix, is trying to anticipate where they're going to get the most appreciation, which markets. So that makes sense that because of that, they would pause their aggressive buying.
Okay, so I'm going to put up this first chart here. Now, this is just Invitation Homes. We're the largest buyer of houses. This goes all the way, starts at 2020, goes to the first quarter of 2023, which just ended. Everything in the green represents how many houses they bought. And then everything in the black is how many houses that they sold. As you can see, for the most part, they've been buying more houses they've been selling. But why would they be selling houses in 2020 and 21 when money was cheap and home prices were going up? Why would they be selling some houses?
So like anything else, when you're investing, there are non-performing assets or assets that are performing poorly or assets that are simply not performing as well as other assets. So then you choose to reallocate your cash to assets that provide you with a better return.
Yeah. So, and that's pretty much it. And those little shaded areas kind of give you a pretty good idea of what's going on. You have the area on the left, which is the COVID recession. You have the area on the right, which is mortgage rate shock. That's just high interest rates. And then you have the green areas, which is in between, where we still had super low interest rates, and they were able to acquire properties pretty, cheaply. I mean,
Right.
they were borrowing money pretty cheaply. Mm-hmm. So it was really, they weren't chasing home prices. They just were getting cheap money.
Right.
That was really the bottom line. They were getting cheap money.
Yep.
Okay. Here's another quote. Through the first quarter, Yoshi says, Yield Street has yet to buy a single home in 2023. This is a different iBuyer, or institutional buyer, not iBuyer. That's despite the fact that Yield Street would like to grow its single-family home portfolio from its value right now of around $200 million to $1.5 billion over the next 5 years. If the company goes through with it, that would mark a 650% increase in its single-family holdings by 2028. So this isn't like the end of the road, probably. If this one company is trying to grow their portfolio, others probably are too, right?
Right, they are. And so they're taking a breather, which is the reason why buyers right now are having an easier time purchasing homes, because they're not having to compete with institutional buyers. Are you paying more for a home today than maybe you might in the fall? That's possible. But are you having to compete with the iBuyers? Probably not. If you wait and purchase a home when you're competing with the iBuyers, are you going to possibly run into multiple offers and end up paying more for the home anyway? It's possible. But the bottom line is your criteria for the perfect home may not show up on the market at that Goldilocks moment when all the stars are aligned. So for the most part, most people are better off just finding the perfect property and then refinancing down the road.
Here's another quote, but it isn't just about home prices. Interest rates on floating loans offered to firms like Yield Street are still in the 7 to 8% range, Joshi says. Those high interest rates coupled with frothy home prices mean that buying new single-family rentals doesn't make a lot of sense right now for some institutional investors. Some probably still have some cash.
Mm-hmm.
For the most part, they don't. They probably have been, because they have to pay interest on it, they probably borrow the cash right when they're getting ready to close on the house. They probably borrow a bunch, close on the houses, borrow a bunch. So when the money started getting expensive, they said, hey, let's hold off on this, right?
Right.
Because isn't that the whole point? Make money more expensive. Remember, they're not buying 30-year loans. They're borrowing money. It's a fixed rate, though. So the money they borrowed wasn't like an adjustable rate mortgage. Mm-hmm. If it was, there would be a problem. They would all be dumping their properties,
right? Which
is probably the only real external thing that I think could happen to housing, because there aren't foreclosures. Mm-hmm. Almost nobody's behind on their mortgage payment. Mm-hmm. Everybody's got a ton of equity. We do have some inflation, which helps housing. Mm-hmm. We have super, super low unemployment. Even though we're technically going to be in a recession at some point, we have job growth and all these other things. And we have a lot of people who are, their current portfolio of real estate is either owned free and clear, or they have a super low interest loan. Mm-hmm. So they really don't want to sell it. The institutional buyers all at once deciding they're going to dump real estate assets could put more inventory into the marketplace.
It could. And, depending on which market they do it in, it could be problematic for that market. That doesn't mean that it's across the country. It means that it's problematic for a particular market if an iBuyer decides to shed its interest in homes in a single market.
Yeah, the problem is if they just say, hey, let's dump everything in Vegas.
Right, but so here's the thing. It doesn't make sense because they would be cannibalizing their own inventory that way. That means that if they brought to market more homes than can easily be absorbed, then they would get less for each home that they sold. And so they're not going to do that. If they do decide to go ahead and liquidate some of the homes that they're holding, they'll probably liquidate a fraction in multiple markets in order to raise capital and in order to maximize the amount of money that they will get on each home that they sell.
And there's also a good chance that these wouldn't actually hit the market.
That's a possibility.
How can an institutional investor sell if they wanted to sell 1,000 of their 50,000 homes, how could they sell them tomorrow without hiring agents, putting them in an MLS, and then having that, like, a bunch of homes hit the market?
So they would sell them, they would package them, and they would sell them to other investors. They would either bulk sale the whole 1,000, or they would break up the 1,000 by region, by price point, however they feel is most palatable to their buyer. And then buyers would purchase some combination of different price points or different markets worth of homes, whatever their arrangement is. So, for example, they might purchase 250 homes that are between 400 and 500,000 across the country, or they might purchase 250 homes in Phoenix alone, regardless of price. Or they might purchase 250 homes in Las Vegas that are between 300 and 450. Whatever makes sense for their arrangement.
Yeah, and who would buy these? There's literally tens of thousands of funds looking for assets. The Arizona State Police, pension fund, and they realize they don't have any real estate assets in it, and they just buy a bunch of real estate notes on real estate or the asset themselves, and then they have this third party that collects the rents and gives them the money. So they have this asset that pays them a dividend, basically, right? That they can use that money to make pensions. So it's all tied together. It's not like someone would just buy it and keep the money. It might be a fund that's buying this for a huge group of retirees or somebody, pension funds, retirement funds, things like that.
Right. So, to Todd's point, let's say that you're a pension fund and you're going to purchase this this package of 250 homes, and you're purchasing them, let's say, from BlackRock. BlackRock continues to manage the homes, continues to collect rent, continues to do all their property management duties, but they no longer own the homes, and so they just get a management fee and then send the proceeds to the pension fund. So there are all kinds of ways to do this. This would be good for BlackRock because they would get liquidity. It would be good for BlackRock because they would get the management fees. So it's good all the way around.
I am pretty sure that these institutional investors who started buying properties were watching our videos from 2010. Because there was a lot we were talking about like in 2010 we talked about a lot of scenarios, if you go back and watch our super old videos, about these different ways that institutional investors should be buying real estate, because it wasn't a thing that existed before, and it's magically really started happening around 2010. So
absolutely.
Yeah.
All right. So what did you think? Was it interesting? Did you learn something? Did we give you ideas? Yes to any of those is fantastic. No, that's completely okay too. Please leave us comments. Let us know what you think. Let us know what's important to you, and we'll respond to as many comments as possible. Remember to subscribe, hit the notification bell, share the video, like the video, and we'll see you on the next video. Bye.
Bye.